ever.
Oh
I
my
was up all
God, you
night.
are live. It's a cold opening, Jason. Hello, everyone. Welcome. We are in the dark. We have no electricity. This is the coldest opening ever. And the CPI is out, I think. Well, Jason's going to talk about it. We'll be there in a second. Oh my God, you're insane. You lunatic. It is cold in here. We're getting snow outside, for God's sake.
You're in Chicago.
I know.
Let's forget.
Good morning, gents. How are you? What's going on?
Good morning. Good morning.
So we have some
Morning.
data
Oh,
to
no,
discuss. I see we have some data to discuss among other important data points. Jason, have at it. Something was hot and something was cold relative to the data points.
Yeah, I mean, PPI, the Purchasers Price Index, was very hot. That's showing that inflation. Maybe we've bottomed in inflation. It's it came out. I think it was like 0.7 month over month. They were expecting 0.4. I think it was like 0.1 or negative 0.1 or something like that the month before. So it's it came in hot and kind of showed, like all that retail spending data that we had yesterday, and maybe all the very low unemployment. Maybe it's starting to creep into the Purchasers Price Index. But then the Philly Manufacturing Index came out, and it's showing it had a negative 24.7 print, which means that they had a slowdown of 24.7%. I mean, that's a huge drop. And last week the Empire State, I don't know why they call it that. They should Philly, Empire State. Why don't they call it Philadelphia and New York, right? But but the New York Manufacturing Index, or the Empire State Manufacturing Index, wasn't so bad. I mean, it wasn't great, but it wasn't bad. And this one, that was just market should be selling off on data like this.
So it's why is that the case? It sounds like you said inflation's going lower. Is that what you were?
No, it's going higher.
Oh, I thought you said inflation's going lower. That's why I got confused.
No, manufacturing growth is going lower while inflation's going higher. That's a stagflation.
Okay.
That's stagflation, and that's really hard for the Fed. That means the Fed's going to have to raise higher. They're going to have to raise stronger. And, even though retail spending has been higher, if you're looking at the business side of things slowing down, it can get pretty nasty. And, there's been a hyperbolic increase in credit card debt, like, private unsecured debt. So there's a lot of data points that are saying soft landing may not be the right place to be.
So what do we do in this environment now relative to the trading strategy? Mark, are you doing something any different for this kind of environment or no? Sorry, Jake.
It's hard to say. I mean, I think a lot of these data points over the last couple of weeks have just been more and more confusing to me, right? They seem to be going in different directions. And, I know the no landing scenario is getting thrown out there in addition to the harder, the soft landing. But, I think we have a Fed who said they're very data dependent. Everyone's watching these numbers like a hawk for exactly that reason. But it just makes the uncertainty really creep in, right? When you have numbers going in different directions. And I don't know, it makes it hard to come up with a strategy other than be nimble.
Yeah. Jason, you were going to say?
I think the big thing too, I agree with you, Mark, that the headline numbers go in many different ways. But when you look, the kind of devil is in the details. And, especially with the jobs number, it was very, very hot. A couple of weeks ago, it was 517K jobs created. But you look, and that's a slightly adjusted number that, with every January they do a population adjustment. So there's a lot of different things that went into that number that didn't magically create, 517,000 actual jobs. So I think a big part of all this data coming out is you have to kind of look at the details and sift out what is Mathemagic versus mathematics.
Mathemagic. I like that. That's good.
Look at the CPI, right? This last release was a new formula there too, right? So you've got some tinkering going on underneath the hood. You know, if you break down CPI in terms of housing, we're still talking about that as a lagging indicator, and you know how much that's contributing to the whole core number too. So you know, there's a lot going on, and makes it hard to read the tea leaves of which way the market's going to feel on any given day. So you know, to me, that says short-term trading strategies are a lot harder here. That we're going to see a lot of ping pong, you know, based more on emotion than fact.
Yeah. So is
dealer positioning?
Yeah, right. I was just going to ask Jason, is there any data around Volund that's showing interesting Vana points in this market?
Yeah,
you had one
absolutely.
at the 4100 level, I thought last time, or 4200, I can't remember, but we kind of got up there. So
it's a little bit different nowadays.
Oh, it is.
So let me share my screen. Oh yeah, it changes all the time. I mean, people buy and sell options all the time.
Right? Well, you would think at 47 million
like
a day,
40 million every day.
Every day is right. That's a cold open if you ever saw one. All right, what are we looking at? Oh, here we are.
So
SPX.
This is
okay.
Yeah, so you can see that when we had that big buying gamma run, I mean, we've been going up over the past couple months. Even with this fall, we haven't even touched the downside area. But now there was a lot of hedging at 4,000 and 40.50, and that JPM strike here, 40.65, seems to be the last area before we start hitting that gamma downturn.
Okay.
So
I missed the number.
I would.
Would you say 40.65? Okay, 40.
Mm-hmm.
So that we're getting close there, right? Right now,
we're practically touching that.
Yeah. Okay.
Yeah. So if we drop past that, we could see a decent sized drop even before option expiration.
Yeah.
And in fact, the option expiration will probably exacerbate it because the gamma is very high when you're close to the money. And if you're at negative gamma and it's very high, you can we might see south of 4,000, and it could get pretty ugly.
Yeah. So, but from the lows of the end of the year to where we are now, we're still up pretty well for this year, which is only a month and a half old, right? Right. It's been quite a rally. I'm shocked, right?
Yeah. Well, I mean, if you look here at Charm, and this is going to be the saving grace of SPX, it was super high all year long, which means that market participants have re-entered the market and they've started hedging. So they've started buying puts, and the premium on those puts were still pretty high. We're still, in the, I guess now, like the 16 to 20 area, 18 to 20 area. I guess today would be much higher, but it's still pretty high. And that premium burns off, and we get a nice paced advance as long as nothing like these data points come out. If these if data points come out and we're not hedged for it, like we weren't, that's when the chance of a gamma sell-off is much higher.
Yeah. Okay.
But until something like this happens, you see a measured, taking the stairs up and the elevator down. And today, I guess it's going to be a broken elevator down.
Yeah. Okay. Am I going to give odds up on the day or no?
Oh, I'd like to hear some.
Ooh, up on the day. Where are we now?
Up on the day.
Oh, wow. The Dow's down 300.
The last 3 days, sell-offs haven't been quite this big, but we've rallied back from 30, 40-point deficits a couple times, twice in this past week, I think. The market certainly is acting resiliently towards that. I don't know if resiliently is an adverb, but it's taken these in stride.
Yeah, that's the thing. I keep. Yeah, go ahead, Jason. Sorry.
Yeah, I think a lot of it too is this Charm and Vana kind of impact, because there has been so much hedging and it creates such a huge cushion. And especially for February, there was such a big cushion, and it still is. I mean, you look at that Charm number in SPX, and it's it's looking at 1.6 billion, and you add in 1.2 billion notional. You're looking at 3 billion notional. That's a lot of buying that has to be done just on data time decay. But again, if we drop, gamma becomes a heavier influence, and we won't bounce back. So I mean, I'll take your odds on high of the day. Let's hear it. Green on the day.
You think that you don't like up on the day? I know that.
I think he's saying
Not
he does. I think he's.
You
he's
do
saying
like
It actually depends though, because we're only at like 40-90, so there is a chance. I'm not going to say there's no chance.
Yeah.
But if we pass 40-65, no chance.
No chance. Too much hedging.
I think if we pass
Selling
40-65, no chance. Too much negative hedging.
Okay. Oh man, I got to think about that one then. I'm gonna have to send that to you in an email. I got to do some analysis. I got to look at a seagull.
It's the birds that I'm paying attention to aren't necessarily going to impact the flows in the short term. But what I've seen is that further out, that's where we're seeing some of that put buying. That after the news came out this week, you had the near term, call it the 30-day skew vol indices. Both of those were coming in, whereas the 90-day they were going up. People were buying puts out 90 days. People were buying vol out 90 days. I think from what I'm seeing in those two time horizon comparisons, the people are shifting further out and expecting a little bit more mayhem to potentially happen in the medium term.
That's interesting.
Mm-hmm.
Yeah.
I'm looking now at
yeah, you can show that too, Jason, right?
Yep. I'm looking now at the this is just delta. This is straight delta, but in the next 3 monthly expirations, you're right. There's quite a bit of puts. I mean, these are usually box trades way down here at like 2,000. They're box trades, so I wouldn't worry about that. But it looks like people are selling puts here at 38.25, but they're buying it closer to the money. I don't know.
Interesting.
We'll see.
Right? Mark's going to get his seagull on if it's the last thing he does.
Oh yeah.
Oh yeah.
That call's still tracking about 5-6%.
Oh, good. Okay. I think Mark bled out there. Yeah.
Yeah.
Jason, are you still with me?
I'm with you.
All right, Mark's on bleed. So what do you think? What's the what stops all this? I mean, how do you get they're trying to avoid stagflation, recession. I mean, do we just have to go through the tunnel here and come out the other side?
I think here's the thing. The Fed is between a rock and a hard place, because if growth is declining, like business growth is declining, like manufacturing, and inflation is going up, it's either they raise interest rates hard in order to control inflation, but that destroys growth, and it's hard landing time. Like, it's a recession that generational recession kind of thing. But if they allow inflation to run hot, then growth will be back, but then pricing power gets out of control, and all of a sudden our dollars are worth nothing. So really they are really stuck between a rock and a hard place, and it seems like Powell is taking the approach of Volcker, which is raise interest rates despite declining growth and get pricing power under control, which is the right way to go. But
it is the right way in your opinion?
I mean, for the long-term future of the economy, yes, that would be the right way to go.
So that means that we take some short-term pain here, right? There's Mark. Mark's back.
Economically speaking, yeah.
People's on.
Yeah.
Just kidding.
All right. Yeah, well, you just missed. Jason was giving his thoughts on how we get out of this conundrum, this economic conundrum we're in, and hard landing versus soft landing. So I don't know if you want to add to that. Basically, the answer is put your seatbelts on. It's going to be a bumpy ride. So
I would agree.
I think like as far as like personally, if you're looking to protect your family and looking to protect your income, I mean, the first thing is do not willingly give up any sources of income. I mean, if you have a good, solid job, you have, especially nowadays, you could probably get a job in like a lot of trades and, and be pretty safe. I mean, there'll be some that will see declines, but right now that's a place to get your job. But the other thing too is if we experience declining growth and higher inflation, you need, I mean, for all intents and purposes, like commodity kind of, you need to get out of any kind of unsecured debt and make sure that, that the things that you need, you get them now before they're going to become very, very expensive in the future or be unavailable because too many companies are going to go under.
Sounds bleak, if you ask me.
Wow, I don't know if I'm glad I signed back in.
Here, I'm going to turn off my light. I'll turn it off.
Holy cow, it's dark in here, dark and cold, and now Jason's giving us the I want to jump out of the window speech. My goodness.
The bear porn.
Mark, tell me a good story. Tell me something nice.
Wow. I just got told I need to learn a craft and start baking my own bread again or something.
I'm hoping you have a good bird story to tell me. Tell me something about
this sounds like
something about a condor or something. Gosh, this is hard.
I was gonna go short condors, but Jason's convinced me I got to be buying these wings, and maybe not even the upside wings.
Yeah. So let's hit on that short condor thing. I want to talk about that because we have the biggest debate about what you call condors when you sell both spreads and you get a credit on each, right? So is that a long condor or a short condor? Now, I've been corrected 100 times. What do you think?
I think if you're
collecting,
you're short.
Okay. I could argue that. I see I see that as being the case, right? Can you make an iron condor on the same side, calls and puts and puts? So could you buy the lower strike
in the money
in the money
short condor?
I'm sorry, in the money calls as one of your legs, and then out of the money, credits. It's going to be a debit ultimately, right?
Yeah. So I always say buy a condor and sell a condor.
Then it behaves like the put side of it. They both behave similarly, but one's a debit, one's a credit. So are you long it when it's not iron? One's just a condor, I guess. Anyway,
I think if you're short vol in the trade, you're short the condor, whether it's a debit or credit.
Okay.
I like that.
But the margin is the same as we've discussed before. Whether you do it with a debit or whether you do it with a credit, maybe you get a dollar difference of margin due to some interest consideration on the value of your spread or whatnot. But functionally, it's the same.
Yeah, but I guess And going back to your comment though, in this environment of volatility, are you doing the opposite of that typical condor, or are you doing the way that probably most retail traders do it, where they sell the put spread, sell the call spread? Or are you doing the opposite in this environment?
I would say typically when I get involved in a condor trade, I'm on the short side.
Yep.
I like it as like a well risk managed, way to, short volatility basically. And I mean, I think that's its best use case. As far as trading it on the long side, I think, to the extent that you want it as like wing protection or something like that, like I don't know that makes as much sense for retail use cases. If you're worried about the downside, there are more targeted ways you could do that. Of course, but so long story short, like I think it's a better trade typically on the retail side from the short side.
Right. Okay. How about legging? Reason I ask is because I feel like in this market, for whatever reason, and I'm not saying this is the way to do things, I'm just saying this is what I've been doing, is every rip your face off rally, I mean, we've had some pretty good ones. I feel like I want to sell it every time. So I end up selling a call spread in something, and either I'm buying that call spread back because I was right. That happened to me the other day in something. Or putting it on the other side at a great price. Now I'm thinking to myself, well, I got this nice profit. I could take it off and put it in the bank and walk away and not worry about it. Or I could put the other, put spread on at a great price and have a great spread on. So
Let me tell you something. Like the way I like to do condors, as far as like legging goes.
Yep.
If if your condor is close to expiration, you're kind of
Mhm.
getting toward one of your legs.
Yep.
I do take off the winning leg at, I call it paying my lunch money if I believe that we're coming back down. But the other thing I like to do as like an adjustment, this is my personal terminology. You probably never heard this on the floor or whatever, but I call it the squeeze condor, because as you get toward one of the legs like that, I move back this one just a little bit and move this one up in order to get the same credit, so I don't lose my profit target.
Wait. I gotta understand that. So let's take the call side and the put side, right? So you're saying
Okay.
that the underlying breaches the call side, let's say. So it means it's moving up, the stock is, and your call
Or it gets
spread's
close.
your call spread's getting more and more pricey. So you're losing on that, but you've made on your put spread. So you're saying you buy in the put spread and roll it up? Is that what you're saying? I want to make sure I understand this.
Yes, and rolling the call spread back in order to and try to make it neutral.
Gotcha. So when you say back, you mean away, moving the call spread higher,
away from
moving
the
the put
price,
spread higher, rejiggering where everything is, but at least taking some profits on one of the puts on the put spread.
Yep.
I like
applying
that.
it to adjusting the call spread.
Would you ever invert the put spread and the call spread, meaning the move got pretty big pretty fast, you're buying in that put spread and you don't have a chance to move that call spread up, you actually inverted it all the way? Have you ever seen that?
What do you mean?
Never take a loss, right? Never take a loss on one of those spreads. You're always taking profits on the put. You're taking a loss on the call, but you got to keep selling more. I've seen that done before.
I don't think I've ever, like, if I breach and I'm way out of there, I have to reassess my thesis. If I think it's going to come back, then I will sell the put spread and leave on the losing call spread to try to, get some money
Wiggle
back.
out of it.
Yeah,
I got you. Okay. Mark, were you going to say
but
something?
I have to readjust. I have to look at my thesis though.
Well, I don't know the thesis part. I don't have a thesis on trading. Do you actually have a paper? You have a written paper on something? There's nothing. We'll just react.
I call it a thesis. It's like if I'm bearish the market or something like that, or if I'm, collecting cans downstairs and some data point comes out that makes me think, maybe my bearish thesis is incorrect, then I will take off the trade.
Got it.
I know it's hard though when you're losing despite the fact that your thesis doesn't change. That's
right.
Then you got to be really confident,
Yep. Mark's thesis is sitting behind him. See those empty bottles of wine? When you have one of those, you're like,
right back
new
there.
thesis.
It sounds like I better hold on to some of these if Jason's thesis is coming true.
That's right.
I'm going to be bartering these in Armageddon.
There you go. I know, right? All right. We got to run. Good seeing you guys. We'll keep an eye on this crazy the CPI thing. I'm worried about the hard landing part now. Now I got to go study that. Thanks, Jason.
No problem.
Sounds like no landing is worse.
Study.
No landing's worse, right? At least we landed. All right. You guys have a good rest of the week. I'll talk to you afterwards.
All right. See you.